China is back to running massive trade surpluses again, thanks to all of the exports that it is doing of masks, gloves, PPE equipment, and other pandemic-related items that it is exporting all over the globe. Now, normally a central bank like the People's Bank of China, which maintains a strong fixed exchange rate with a dollar peg, will not allow its currency, when a country is running massive trade surpluses, to strengthen massively, like what has happened over the last few months with the Chinese yuan against the dollar. And yet that is what has happened. The Chinese yuan is now trading around a 6.5 Chinese yuan to the US dollar exchange rate, which is very good for people with purchasing power in Chinese yuan, shockingly. And the dollar has been very, very weak now for months, with record budget deficits blowing out, and the dollar index has been very weak. So that should be good for gold in the long run. But beneath the surface, beneath how China is exporting massive amounts of PPE equipment and other pandemic-related items, beneath the surface is a lot of problems still with the Chinese economy, including how AAA rated companies, just recently in the last 2 months, state-owned enterprise AAA rated companies have defaulted on their bonds. So there's been a number of articles on this, about 4 or 5. I'll attach different ones below the video in the information and description section. But there is a lot of capital inflow going into China, a lot of investors who are yield hungry, who are seeing China's currency appreciate, who are looking at the trade surpluses, want to invest more into China. The Chinese government issued negative yielding bonds, and the US is trying to counter this while Trump is still in the White House. And the US is trying to block, with Morgan Stanley, taking out Chinese companies out of the MSCI Emerging Markets Index. And now we'll see what happens with Stephen Roach, who is, according to a Beijing economics professor in a recent speech, a CCP agent. He's a former vice president at Morgan Stanley Bank for many, many years, their Asia division, and I think he's a lecturer, he's a professor now at Yale. But it was admitted that he's a CCP agent. But beneath the surface, there is still a lot of problems with the Chinese economy. So despite the Chinese economy looking great, with all of these trade surpluses, massive ones that China's back to running, and they're importing massive amounts of commodities again. They've stockpiled enormous amounts of food due to the flooding and other problems. Energy, their strategic petroleum reserves, they have an enormous amount. The coal prices, KOL has shockingly done very, very well, despite China talking about green energy initiatives. But again, beneath the surface, we have a AAA rated coal company, state-owned enterprise coal company in China that just defaulted on the debt, and I believe they were in KOL. So let's talk more about some of these defaults, how despite all this capital inflow into China, a lot of these state-owned enterprise companies that are AAA rated on their bonds, probably overrated on their ratings, are starting to default, and there's been some big name defaults in the last 2 months, according to articles. More than 90% of Chinese-rated issuers have stamps of AA or higher. That absence of differentiation has complicated efforts to price risk. A default in late October by Huaqin Automotive Group Holdings, the parent company of German automaker BMW's Chinese joint venture partner, exemplified opaque risks, underdeveloped pricing mechanisms, and investor naivete in China's corporate bond market. Quote, if the company had told investors it was in great trouble, I wouldn't have bought and held the bonds, end quote, said Shanghai-based hedge fund manager Vincent Jin, who bought Huaqin bonds earlier this year. Huaqin boasted a AAA issuer rating when it launched its 1 billion yuan or 151.93 million 3-year privately placed bond in October 2017. It comes from one of China's poorer provinces, Liaoning, but as recently as April told bondholders it has adequate cash, lots of land, and state backing. And this is the issue that I have with a lot of foreign companies, whether it's China, Eastern Europe, Russia, many other countries outside the United States, is can you trust the accounting? And hedge fund managers over the years in the Chinese reverse merger scam that was featured in the famous documentary China Hustle, which I highly recommend, even some of the best hedge fund analysts on the planet that are highly paid that went for site visits were fooled too with the China Hustle. Creditors were therefore stunned when Huaqin not only defaulted, but was also dragged to court by a creditor for bankruptcy restructuring. Moreover, 1 month before its bond delinquency, Huaqin transferred its prized 30% stake in Hong Kong-listed Brilliance China Automotive Holdings Limited to a subsidiary, leaving bondholders with no access to those assets. So the assets were moved around to a new shell company or LLC, hiding the assets. That is really, really bad. Here in the United States, I think that would probably get the corporate executives. That's like Enron level fraud. For investors, that leaves big questions about state-owned enterprises' changing risk profile and their relationship with the government, with the parent government, the Chinese Communist Party. In the central province of Henan, Yongqing Coal and Electricity Holding Group, a AAA-rated state-owned mine operator, defaulted on November 10th, only 3 weeks after issuing fresh debt and a week after moving its stake in Zongyang Bank to 2 government subsidiaries. State-owned enterprise defaults are not new, but blocking bondholders from liquid assets is, said Rocky Fan, an economist at Sealand Securities. Quote, "It's like telling investors, I don't want to pay back your money," Fan said. Quote, "If that's the case, there's no way you can assess a company's risk or price a bond based on its fundamentals." Yongqing's 70-day commercial paper bore a 4.39% coupon payment, well above the 1.84% risk-free rate on government debt at the time of issue, although, like I said earlier, the Chinese government did issue some negative yielding debt not long ago because of all the capital inflows, including Japanese pension funds. Shockingly, there was Japanese banks and pension funds even buying Chinese debt, which given the country's history is a little shocking. The 1.8, okay, their risk-free rate on government debt at the time of issue, but quote, "still low considering the risks," said a director at a local securities firm. In a separate instance, Tsinghua Unigroup, a chip maker backed by Beijing's prestigious Tsinghua University, defaulted on a 3-year 1.3 billion yuan bond on November 15th, shortly after a ratings agency warned of debt risks at the company. The defaults sent other bonds issued by Yongqing, Huaqin, and Tsinghua Unigroup to about 1/10 of their face value, so the bonds crashed 90%. Quote, "For too long, risk has been mispriced. This is what misallocation of capital looks like," said Fraser Howe, an independent analyst. Quote, "You've been pouring money into companies that simply don't deserve it." This article here from December 13th from Bloomberg News, which there's rumors that Bloomberg News could potentially be kicked out of the country, and the Chinese government could not only do that, but also cancel orders on Bloomberg terminals. There's been rumors swirling about that for the last couple months. Investors are learning to live with China's credit defaults. China's authorities are increasingly spreading the message you should get what you pay for when it comes to corporate bonds. Beijing is allowing a wave of defaults by state-linked companies in the country's 15 trillion credit market. According to Kyle Bass and others, the credit market is a lot larger than 15 trillion. It's at least 3 times that. It's on its way to 4 times that, considering how many new bonds are being issued, especially dollar bonds. But now with the weaker dollar, that might not be that bad of an idea. Last week, prominent chip maker Tsinghua Unigroup defaulted on $450 million of dollar debt, triggering cross defaults on another $2 billion, equivalent to almost 2/3 of the total defaulted debt in China's offshore bond market in 2019. While this may be bad news for the weakest state-owned enterprises, it's an improvement for investors, the credit market, and China overall. A more accurate pricing of risk gives buyers of bonds greater transparency in a relatively opaque economy. That would boost the allure of Chinese debt, drawing more inflows, and we've seen a lot of capital inflows because China is running enormous trade surpluses, and also their currency, the People's Bank of China, is allowing the Chinese yuan to strengthen. That would boost the allure of Chinese debt, drawing more inflows, which in turn would help reduce the reliance of the nation's capital markets on the government. State banks, but what's risky here is still how foreigners are treated, because the rules can still change at any time for foreign investors. Kyle Bass has said that there's one multinational foreign company who cannot get $10 billion worth of cash out of the Chinese economy. It's stuck in their banking system. And he says that he's spoken to the senior executives and everyone would know the company's names. I personally think my educated guess is that it's Apple. State banks are among the biggest buyers of onshore corporate debt. Quote, "For the first time, we might have the opportunity in the medium term to have a genuine local high-yield market." And that's what has been missing for years in China. So even more credit in the Chinese economy then. According to Jean-Charles Sambor, head of emerging markets fixed income at BNP Paribas Asset Management in London, 2021 could be an inflection point for the introduction of a genuine credit risk mechanism in China. Again, I'm still worried about how foreigners will be treated, private property rights, and rule of law for foreigners. Though the November defaults sparked a brief sell-off and canceled sales onshore, Unigroup's default did little to shake the broader offshore junk market, where yields actually dropped. The risk was contained to holders of debt issued by Unigroup, a company that's been missing payments for the better part of a month. Improving the efficiency of the debt market is becoming a priority for policymakers. They have a tough climb ahead of them. In China, about 96% of onshore credit ratings are the equivalent of investment grade. So it sounds like the credit ratings are drastically overrated, given how we're seeing over the last 2 months a lot of AAA rated bonds suddenly default without warning from state-owned enterprises. China's central bank has vowed to improve its oversight of the ratings industry. The 3 major credit ratings agencies here in the U.S., so your S&P, Standard & Poor's, Moody's, and Fitch are all full of shit too. And the one honest one was Egan-Jones, and look how they were screwed over when they downgraded a European Union country government debt in 2011 and 2012, like Greece and Germany, and then they downgraded the U.S., I think, in 2011. And look, all the bad things that happened to Egan-Jones. They were like the last honest ratings agency. China's central bank vowed to improve oversight ratings industry. People's Bank of China Deputy Governor Pang Gongsheng said sector problems include inflated credit ratings. Okay, that's at least being honest. And these firms need to improve their quality of work, according to a statement of the PBOC's website dated Sunday. In fact, 2 former general managers at Golden Credit Rating International are being prosecuted for allegedly inflating the ratings of some companies that offered bribes. A shocker there. I mean, it happens in the U.S. too. No one's going to prison for it, though. According to a Monday statement from the Central Commission for Discipline Inspection, the recent defaults are prompting investors to put a premium on state-owned firms, especially the weakest ones. The average yield on riskier state-owned enterprise bonds rose to a record 7.36% on December 10th. Even top-rated state-owned enterprise bonds are starting to feel some pain. The average yield on their bonds is about 5%. That's up 32 basis points. 100 basis points is 1% for reference, for those of you who are not familiar with what a basis point is. From a year earlier, Bloomberg compiled data show, quote, between the best and worst provinces and the best and worst state-owned enterprises, there was a very limited difference in terms of credit risk, and this is changing, Sambor said. Investors' equanimity doesn't mean Beijing's plan will proceed smoothly. Pockets of pain may emerge around a certain industry or province, and if you want to learn more about that, listen to the excellent interview that Kyle Bass did with China expert Michael Pettis, who is a finance professor in Beijing, I believe. He used to work for investment banks and on Wall Street for many, many years, Michael Pettis. That is available for free on the Real Vision YouTube channel. Came out in the last couple months, where they talk about how the Chinese banking system has been insolvent for the last 18 to 24 months, and they're still selling more credit. Pockets of pain may emerge around a certain industry or province that may drag down good credit with the bad. Since last month's unexpected default by Henan-based Yongqing Coal and Electricity Holding Group, only one non-financial firm from the province has managed to sell debt, but authorities will be on guard to limit any broader impact from defaults, according to Thua Ya Chow, a portfolio manager at Loomis Sales Investments Asia Group. Quote, we do not expect regulators will allow for a disorderly sell-off to cause a systemic risk, said Chow, who's looking for buying opportunities among onshore state-owned enterprises bonds in the year ahead. What is important for China's bond market development is for defaults to be resolved in a fast and predictable manner so that companies and investors can appropriately price risk rather than artificially avoid defaults which lead to moral hazard. Again, what worries me about investing in China as a foreigner is lack of transparency in accounting, private property rights for foreigners, and rule of law for foreigners. And now we're seeing that the U.S. and China are still in a trade war. We'll see what happens after Biden and Kamala Harris are in the White House, because it looks like Trump is not going to end up in the White House for a second term, and how Biden and Kamala Harris decide to proceed with the tariffs on China, and then how NASDAQ and the MSCI, Morgan Stanley's Emerging Markets Index, how NASDAQ is delisting Chinese companies. The Chinese government, if they have not already done so, will retaliate. 100% guaranteed, because they always retaliate. Normally the retaliations by the Chinese Communist Party are even worse than the sanctions the US put on. Look at what's happening to Australia now with all those economic sanctions on barley, wine, lobster. It's a long list of sanctions against Australian companies by the Chinese government. And then with Chinese companies that were in the Morgan Stanley Emerging Markets Index, MSCI, how Morgan Stanley took them out. And we'll see if Stephen Roach, a CCP agent, according to a Beijing economics professor in a speech that was deleted and covered by Tucker Carlson on a show in the last week, the video was played. It's going all around the internet, where this Chinese economics professor admits that they have an agent on the payroll at one of the major investment banks. And we'll see how that plays out. But beneath the surface, so the Chinese economy is doing well with its exports of many items that are pandemic related. They're importing massive amounts of commodities, but it is risky which commodities that you bet on, because if the Chinese government stops buying them, all of a sudden they could crash. And you've seen the copper price just go crazy now since really the beginning of April. The copper price has been on fire. As far as infrastructure projects, China is planning to build another 200 plus airports. I don't know where they're going to put these airports, but that's a lot of additional airports. They already have a lot of airports, but this is misallocation of capital too. But if you're speculating on commodities, there's good bets there in the short term. But if China does stop buying these commodities, they can crash. So be careful out there. If you're speculating, the bets are which commodities is China going to buy next. Please consider becoming a patron over on my Patreon and chipping in $5 or more per month, so that way I can continue to do my research and make unique content and be able to make a living. Because with my YouTube channel, my Google AdWords revenues have collapsed almost to zero. My YouTube channel subscribers have stopped growing in the last 9 months. There's no growth there. And my live stream shows have been shut down, and YouTube tech support is giving me all types of excuses, claiming that they did not put a strike on my account, even though I can't edit the title for a live stream show. I cannot turn monetization back on. I cannot even turn live chat back on. That's how bad things are with the live stream show. I have almost 150, and hopefully soon it will be over 150 unique pieces of content behind the paywall on Patreon in terms of well-researched articles. Some of the articles have taken me many, many hours to produce for lots of different topics about gold miners, silver miners, precious metal royalty and streaming companies, a lot of articles about the oil industry and other commodity industries, also global macro related articles. There's also audio podcasts on a lot of stock charts and technical analysis there too. And while you are getting unique content, if I go over 1,200 patrons and I stay there, I will sign up for another live streaming service just for patrons. So I will make this pledge, I will make this promise, if I go over 1,200 patrons and I stay there. So if I drop below 1,200 patrons, the promise is not going to stay. I have to stay at 1,200 patrons and stay there. I will start to do live stream shows just for patrons behind the paywall there. Will require additional capital. I will have to sign up. I think it's $100 a month for another service there to integrate with Patreon, to sign up there and integrate. So that will be an additional added bonus for patrons if you want to take me up on that. But please chip in if you can, as YouTube is basically trying to make this impossible for me to grow my channel or to make a living from making content.